Sales taxes payable is another type of current liability. So as a retailer, if you're going to sell merchandise and you need to collect sales taxes on behalf of the state, you are going to become a collection agent. So those monies that you collect on behalf of the state are a liability to you until you actually remit them back to the state. Let's take a look at what those transactions might actually look like. So for example, on May 31st, we recorded cash sales of $420,000 for the month, plus sales taxes of 5% collected for the state of Maine. It says ignore cost of goods sold. That makes it easy for us. And then on the 6th, we remit those monies back to the state. So let's see here. We've got on May 31st. We would debit cash for the amount collected from our customers. So that is not only going to include the sales amount of $420, but the customers will also pay the 5% sales tax. Let's calculate what that sales tax will be. So $420,000 times 5% equals $21,000. Okay. So our cash collected will be $420,000 plus $21,000, which is $441,000. We know we're going to have a credit to our sales revenue, just like we've been doing all along, for $420,000. The only difference here now is that we have this new liability for sales taxes payable. Which is $21,000. Okay. So if I add together my sales plus my sales taxes payable, I get the amount of cash that my customers are going to pay me. Now it's time to go ahead and pay the state. So we're going to go ahead and debit that sales taxes payable because we want to get rid of that liability for $21,000, and we will credit cash for $21,000 as well. Okay, just a couple of items of note here. So when we actually credited our sales taxes payable, that increased our liabilities by $21,000. And then when we debited it, we decreased it by $21,000. So just like we were doing with notes payable, these two cancel each other out. The debit offsets the credit for the